The Federal Reserve just made a decision that will destroy the American middle class. Not might, will. And if you understand what I'm about to show you, you'll see it's already happening. Right now, the United States is carrying $38 trillion in national debt. The interest payments alone just crossed $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare, and they just announced the final 4 candidates to replace Jerome Powell as Fed chair. One of them is Rick Rieder from BlackRock, the man who controls $3.2 trillion in AI investments. You know what that means? They're choosing the bubble over reality. They're choosing to inflate the greatest financial disaster in human history rather than face the mathematical truth. This isn't about market corrections. This isn't about normal cycles. This is about a $50 trillion artificial intelligence bubble that makes the dot-com crash look like a minor adjustment. And every single indicator is screaming that it's about to implode. Let me show you something that will change how you see everything happening right now. Every massive financial bubble in history follows the same pattern. Same stages, same warning signs, same devastating outcome. Tulip mania in Holland, 1637. The South Sea bubble in England, 1720. The dot-com boom in America, 2001. Each time, the story was different. The technology was different. The promises were different. But the mathematics were identical. Stage 1, revolutionary technology appears. Everyone says it will change everything. Early adopters make extraordinary returns. Mainstream adoption accelerates. Stage 2, speculation overwhelms fundamentals. Valuations detach from any rational calculation. Easy credit fuels even more speculation. Everyone who isn't buying feels stupid. Stage 3, reality intrudes. The technology delivers less than promised or takes longer than expected. Earnings can't justify the valuations. Credit tightens. The smart money starts leaving. Stage 4, collapse. Confidence evaporates overnight. Prices fall exponentially. Leverage magnifies the destruction. Years of gains disappear in months. The middle class gets wiped out while insiders escape with their wealth intact. We're deep in stage 3 right now. And here's what makes this different from every bubble in history. The scale is unprecedented. The leverage is higher. The systemic connections are deeper. And the people in charge are the same ones who created the bubble. Let me prove this to you with numbers that don't lie. Right now, IT investment as a share of U.S. economic output has surged to the highest level since 2001, the highest level since the peak of the dot-com bubble. Market capitalization as a percentage of GDP has exploded from 132% in 2001 to 226% today. But that's not improvement. That's inflation on steroids. But here's what makes 2026 different from 2001. In the dot-com era, companies had minimal debt. They were burning cash, but they weren't leveraged. Today, AI companies are borrowing massive amounts to fund their expansion. They're using debt to buy equipment, hire talent, build infrastructure. When this bubble pops, it won't just destroy equity values. It will trigger a debt crisis that cascades through the entire financial system. The IMF just published a report on January 19th that should terrify you. They stated explicitly that if AI firms fail to deliver earnings commensurate with their lofty valuations and investor sentiment sours, global growth will fall by 0.4% relative to baseline. That's economists speak for when the AI bubble pops, we're all screwed. But even that understates the problem. Because the IMF is assuming this will be a normal market correction. They're not accounting for the leverage. They're not accounting for the systemic connections. They're not accounting for the fact that AI investments are now central to pension funds, sovereign wealth funds, and central bank reserves around the world. BlackRock alone manages $3.2 trillion in assets. Rick Rieder, their chief investment officer for global fixed income, is one of 4 finalists to replace Jerome Powell as Fed chair. Think about that. The man who's been pushing AI investments for years, who controls more money than most countries' GDP, might become the person who controls American monetary policy. If that's not a conflict of interest, nothing is. If that's not regulatory capture, the term has no meaning. Here's what happened during the dot-com bubble. From 1995 to 2000, technology stocks went parabolic. Everyone said this time was different. The internet would revolutionize everything. Traditional valuation methods didn't apply. Companies that had never made a profit traded at hundreds of times revenue. Pension funds, university endowments, individual retirement accounts all poured money into technology stocks. Alan Greenspan warned about irrational exuberance in 1996, but then kept interest rates low and enabled more speculation. When it collapsed, the Nasdaq fell 78% from peak to trough. $5 trillion in market value evaporated. But here's what most people don't remember. The dot-com crash didn't happen overnight. It took almost 3 years, from March 2000 to October 2002. Slow at first, then accelerating. Companies that seemed unstoppable became worthless. Pets, Calm, Webin, eToys, hundreds of others, gone. The people who thought they were rich discovered they were broke. Retirement accounts that had doubled became worth less than the original contributions. But the 2001 crash was contained. It was mostly about equity values. The broader economy survived. Banks didn't fail en masse. The currency didn't collapse. That won't be true this time. This time, the AI bubble is connected to everything. Big tech companies are the largest weights in every major stock index. Apple, Microsoft, Google, Amazon, Meta, Tesla, Nvidia. These companies now represent over 35% of the S&P 500. When they fall, everything falls with them. Their debt is held by banks, pension funds, insurance companies. Their employees have stock options that become worthless. Their suppliers depend on their continued spending. Their customers depend on their services. When the AI bubble pops, it won't be like the dot-com crash. It will be like 2008, but worse. Because in 2008, the problem was housing, a $15 trillion market. Today, the problem is technology, a $50 trillion market that touches every sector of the economy. Let me show you the specific warning signs that are flashing red right now. First, earnings can't justify valuations. Nvidia trades at 66 times earnings, Microsoft at 34 times, Google at 26 times. These are not growth stock multiples, these are bubble multiples. In a normal market, companies with those valuations need to grow earnings by 25-40% annually just to justify their stock prices. That's impossible to sustain. Second, insider selling has accelerated. CEOs and founders are selling shares at record rates. They know what's coming. They're cashing out before retail investors realize what's happening. Third, credit is tightening. Interest rates might be falling, but banks are becoming more selective about who gets loans. Corporate bond spreads are widening. High-yield debt markets are showing stress. The easy money that fueled the AI boom is becoming harder to access. Fourth, productivity gains aren't materializing. Companies have spent trillions on AI infrastructure. They've hired armies of engineers. They've promised revolutionary improvements. But actual productivity growth remains modest. The technology isn't delivering on its promises fast enough to justify the investment. Fifth, regulatory pressure is increasing. Governments around the world are beginning to understand the concentration of power in tech companies. Antitrust investigations are multiplying. New regulations are coming. The regulatory environment that enabled the bubble is changing. But here's the most important indicator. The same people who created the bubble are now being put in charge of managing the consequences. Rick Rieder at BlackRock has been one of the biggest promoters of AI investments. Now he might become Fed chair. That's like appointing the architect of subprime mortgages to run banking regulation in 2008. Treasury Secretary Scott Bessent announced on January 20th at Davos that Trump will name Powell as replacement within a week. The four finalists are Kevin Hassett from the National Economic Council, Kevin Warsh, former Fed governor, Christopher Waller, current Fed governor, and Rick Rieder from BlackRock. Three of them are establishment figures who will continue current policies. Rieder is different. He represents Wall Street directly. He represents the AI bubble directly. If he becomes Fed chair, it confirms that the system is beyond reform. It confirms that we're in the final stage before collapse. Here's what the collapse will look like when it happens. It won't start with AI stocks. It will start with leverage. Companies that borrowed to fund AI projects will start missing debt payments. Banks that lent to those companies will tighten credit further. Margin calls will force selling. Selling will drive prices lower. Lower prices will trigger more margin calls. The leverage that amplified gains on the way up will amplify losses on the way down. Pension funds that loaded up on tech stocks will face massive redemptions. Insurance companies that bought corporate bonds will see defaults spike. Sovereign wealth funds that invested in AI ventures will face political pressure at home. The Federal Reserve will face an impossible choice: raise rates to preserve the dollar's credibility, which accelerates the collapse, or cut rates to prevent deflation, which destroys the currency through inflation. Either choice leads to the same place: the systematic destruction of middle-class wealth, because that's how these crises always resolve. The people who created the bubble escape with their wealth intact. The people who trusted the system get wiped out. Let me be absolutely clear about something. I'm not predicting when this will happen. Bubbles can stay inflated longer than logic suggests. Irrational markets can remain irrational for years, but the direction is inevitable. The mathematics are inescapable. The leverage is unsustainable. The valuations are impossible to justify. The conflicts of interest are obvious. The warning signs are everywhere. What should you do with this information? First, understand that this isn't normal market volatility. This is a systematic problem that requires systematic solutions. Don't try to time the market. Don't try to pick winners and losers. Focus on preserving wealth through what's coming. Second, reduce exposure to pure tech plays. That doesn't mean sell everything. It means understand that companies with reasonable valuations, real cash flows, and minimal debt are safer than companies trading on AI promises. Third, diversify across asset classes and geographies. When the AI bubble pops, it will hit the US markets hardest. Having exposure to foreign markets, commodities, real estate, and other assets provides protection. Fourth, build cash reserves. When assets are cheap, you need liquidity to buy. When everyone else is forced to sell, cash gives you options. Fifth, pay attention to debt levels. Personal debt, corporate debt, government debt. High debt levels make the consequence of any crisis worse. Sixth, develop skills that retain value regardless of what happens to financial markets. The ability to create value, solve problems, provide services that people need, these survive economic crashes. The AI bubble isn't a future problem. It's a present reality. Every day it stays inflated makes the eventual collapse worse. Every dollar that flows into overvalued tech stocks makes the reckoning more severe. Every person who believes this time is different makes the wealth destruction more complete. This isn't about being pessimistic. This is about being realistic. The same mathematical forces that created the tulip mania, the South Sea bubble, the dot-com crash, and the housing crisis are at work right now. The only difference is the scale. The AI bubble is bigger than all of them combined. When it pops, it will reshape the global economy. It will destroy more wealth than any crisis in history. It will transfer power from the many to the few in ways we can't imagine. The question isn't whether this will happen. The question is whether you'll be prepared when it does, whether you'll be one of the people who saw it coming and positioned accordingly, or whether you'll be one of the millions who trusted the system, believed the promises, and watched their wealth disappear when reality finally intruded. The mathematics don't lie. The history doesn't lie. The leverage doesn't lie. The AI bubble that will collapse everything isn't a theory. It's not a possibility. It's an inevitability. The only question is timing. And based on every indicator I see, the timing is much closer than most people think. The federal debt just crossed $38 trillion. Interest payments just crossed $1 trillion annually. The AI bubble just reached levels that make the dot-com crash look modest. And the people in charge are the same ones who created the problem. But here's what makes this collapse different from every bubble in history. The AI bubble is connected to everything. Every smartphone depends on AI chips. Every car uses AI systems. Every bank runs AI algorithms. Every government relies on AI analysis. When this bubble pops, it won't just destroy stock portfolios. It will disrupt the basic infrastructure of modern life. The people who created this bubble know what's coming. That's why insider selling hit record levels in 2025. That's why Rick Rieder is positioning himself to control monetary policy. That's why central banks are quietly buying gold while publicly supporting AI investments. They're preparing for the aftermath while ensuring the public remains unprepared. History tells us exactly what happens next. The people who understand these cycles early survive and prosper. They build new systems on the ruins of old ones. Everyone else becomes a cautionary tale. The mathematics are absolute. The pattern is inescapable. The bubble will collapse. The mathematics are absolute. The pattern is inescapable. The bubble will collapse. The only question is whether you'll see it coming or whether you'll be asking, like millions before you, how you missed all the signs when they were right there in front of you. The warning signs are mathematical. The consequences are historical. The timing is accelerating faster than most people realize. The collapse is mathematically inevitable and historically predictable. The pattern never fails us here and now today. This isn't going to end well. And the only question left is whether you'll be ready when it doesn't.